When I started trading 16 years ago, I thought it was all about charts, strategies, and quick profits. What I didn't see were the traps, the scams, the false promises, the years wasted chasing shortcuts that didn't work. In this video, I want to share the truth about trading scams, and more importantly, the lessons I wish I had known back then. These are the insights that could save you years of frustration and help you focus on what really matters in trading.
When I first discovered trading, it looked like the perfect opportunity. Financial freedom, independence, the dream of making money from anywhere. And yes, trading can be that opportunity. But it also has another face. The trap. The scams, the false promises, and the mistakes that can drain both your money and your motivation. I learned this the hard way over years of trial and error. That's why in this video, I want you to see both sides clearly. So you can choose the path of opportunity, not the trap. When I started out, I fell into the first and most common trap, believing promises that were too good to be true. Ads everywhere claimed I could double my money in a week, that someone had a secret strategy no one else knew, or that trading was an easy way to get rich fast. The truth? None of it worked. Every time I trusted those words, I ended up with losses and disappointment. If there's one rule you should remember from my 16 years in trading, it's this. Whenever you hear the words guaranteed, secret, or easy money, walk away. They're not selling trading, they're selling illusions. Early on, I ignored small signals that later cost me. The first is pressure to act now. This slot is limited, deposit now. A classic sales trick. The second is no verified history. If someone can't show a real auditable track record, be suspicious. And the third, the one that should have set off alarm bells for me sooner, is no contract and requests for informal payments. I remember being told, just send the money to this PayPal account, or send crypto to this wallet and we'll start you right away. With no invoice, no written agreement, no proof of performance. That's not convenience. That's no accountability. If they ask for crypto or an untraceable payment method and refuse a simple contract or receipt, walk away. You're giving money with zero protection. Early on, I treated regulation like a checkbox, until I hit a broker that made withdrawals a nightmare. Regulation is not a miracle cure, but it's the single biggest thing that separates a serious firm from a fly-by-night operation. One more thing I learned the hard way. Don't pick a firm only because they have the lowest fees or offer an attractive bonus. Dubious companies know that flashy bonuses and tiny commissions attract beginners. They will lure you in with offers that look irresistible, then make it nearly impossible to withdraw or add hidden conditions that kill your edge. When choosing where to trade, think of it as a balance. Trading costs matter, but they are only one side of the scale. On the other side are regulation, a real license you can verify, the trading facilities they provide, platform stability, speed, customer support, and how long they've been operating in the market. A slightly higher spread with strong regulation, good execution, and transparent terms is almost always better than the cheapest offer with no proof of credibility. My rule now: verify the license, check the country and regulator strength, test the platform, and ask for clear terms. If they insist on informal payments, crypto to a personal wallet, PayPal without invoice, walk away. Your money deserves traceability and protection. If there's one regret from my 16 years of trading, it's that I let money be my teacher too early. I thought live trading would force me to learn faster, but all it did was magnify mistakes. Here's a better path. First, master the mechanics. Know what leverage does to your position size and volatility. Understand how spreads and slippage quietly eat small gains. Learn how execution differs during news. These are not academic details. They change whether a strategy works in practice. Second, treat the demo account like actual school. I used to mess around on demo and switch to real money as soon as I felt comfortable. Don't. Track your demo trades. Apply the same risk rules you plan to use live, and only switch when your performance is consistent over time and different market conditions. Third, focus on psychology and risk. The markets don't punish a bad strategy as much as they punish a trader who breaks their rules. Set simple rules. For example, risk 1% per trade, define stop size before entering, and never move it because of fear. I used to move stops when I felt nervous. That behavior cost me more than any bad indicator. Fix the psychology first, then scale the size. In short, learn, practice, and build the mental habits. That order saves time and money. If there's one lesson that cost me the most in 16 years of trading, it's this: discipline beats strategy. In the beginning, I treated rules as suggestions. I moved my stop losses when I got nervous, I doubled down after a loss, and I let emotion run the show. That behavior erased months of work in a few trades. So here are the practical rules I now live by. First, risk small. A sensible rule is to risk between 1% and 3% of your account on any single trade. For example, if your account is $10,000, 1% is calculated as 10,000 times 0.01 equals $100. That $100 is the maximum you allow yourself to lose on that trade. If your stop-loss distance implies a $50 loss per unit, size your position so the total potential loss equals $100, not more. Second, always use a stop-loss and place it before you enter. Don't treat it as optional. The stop-loss exists to protect your capital and your psychology. Only move your stop-loss after the trade is clearly in profit to lock gains. Never move it closer when you're losing. Third, don't chase losses. After a bad trade, step away. Take a cool-down period, review your plan, and journal the trade. Chasing losses is emotional decision-making, and it compounds errors. Discipline is boring, but it works. Follow simple rules, protect your capital, document your trades, and you'll survive long enough to actually learn and profit. Over 16 years of trading, I've seen scams in every shape. These aren't theoretical. They are real stories from real people, and I've been a victim of a few myself. Here are the 3 that repeated the most. First, fake bonuses. A platform offers a huge deposit bonus or match. It looks irresistible. But the fine print forces you to trade an impossible volume or meet hidden conditions before you can withdraw. I once deposited and only later discovered I had to turn over unreal volumes to unlock my own funds. That bonus turned into a trap. Second, expensive courses that teach nothing new. People pay thousands for pro strategies that are recycled YouTube content or screenshots of trades with no real method behind them. I bought my share of overpriced lessons early on. They burned time and gave false confidence. Education is valuable. But verify the teacher and look for proof, not just testimonials. Third, withdrawals blocked or ransom upgrades. The pattern is simple. You try to withdraw, they delay, ask for extra fees, or say you must pay for an upgrade or compliance to get your money. I heard stories of traders told to send crypto to a private wallet or to pay additional commissions. No invoice, no trace. That's theft, not business. If you ever encounter these, stop, document everything: screenshots, emails, receipts. Contact your payment provider, card issuer, or PayPal to start a dispute and report the company to the regulator in their jurisdiction. And seek legal advice if substantial funds are involved. These steps won't always recover everything, but they increase your chances and help others avoid the same trap. Above all, small deposits and due diligence protect you far better than trusting flashy promises. After 16 years in the markets, I developed a simple, practical checklist I wish someone had handed me on day 1. Use it as your guardrail whenever you sign up with a new service or broker. First, start small. Treat your initial deposit as a test. If withdrawals and support work, then scale slowly. I lost more by trusting big deposits too early. Second, verify regulation. Look up the license number, check the regulator's website, and prefer firms under strong authorities. Regulation won't prevent all problems, but it changes the game if something goes wrong. Third, check reviews and the community. Don't rely on polished testimonials. Look for independent feedback in forums, social platforms, and ask for third-party proof of withdrawals. Real users will tell the truth. Fourth, test on demo and on small live trades. Use demo for at least a few weeks, then place small real trades to validate execution, slippage, and withdrawal flow. Real money tests should be tiny at first. Fifth, demand transparency. Invoices, contracts, clear withdrawal rules, and traceable payment methods. If someone asks for crypto to a private wallet with no invoice, that's a red flag. Follow these 5 steps every time you try a new platform or service. They won't make you rich overnight, but they will keep you in the game. And in trading, staying in the game is the first requirement for success. After 16 years of trading, I can tell you this plainly. Trading is not luck, and it's not a shortcut. Trading is a craft, a combination of skill, patience, and discipline. Skill means knowing the mechanics, analysis, execution, order types, building repeatable setups and refining them over time. You don't become skilled overnight. You practice, iterate, and measure. Patience is the ability to wait for the right setups and to let winning trades develop. Early in my career, I chased every opportunity. Later, I learned that waiting for the higher probability setup preserved my capital and improved my win rate. Discipline is what keeps everything together. It's following your rules when markets are noisy, it's sizing positions so a single loss won't derail you, and it's journaling trades to learn from real data rather than emotion. Put simply, skill gets you entry and edge. Patience lets edge play out, and discipline makes sure you survive and compound your gains. If you focus on these 3 things, and not on shortcuts or guarantees, you give yourself the only chance that actually matters: a long career in the markets.